Hello and welcome to this edition of Equity Sahi Hai, an investor education initiative by Motilal Oswal Asset Management and the Money Mile. Joining me today is Surya Bhatia, well-known certified financial planner, and we're going to talk about how to invest in volatile markets. Surya, thanks very much for joining us. While the Sensex keeps crossing new lifetime highs, we've crossed 38,000 recently.
Yeah.
But again, when investors are looking at their statements, which are coming to them, probably because it's only a few stocks which have taken the Sensex to where it is. But if you look at the mid-cap universe, and we'll talk about that in a little bit, investors don't seem to feel that their returns are at lifetime highs, in this year. Are you getting calls from people who are panicking, saying that, look, the broader market hasn't risen the way it should have, so our stocks, which we bought through mutual funds, are not necessarily doing as well as we thought they would?
I think, Vivek, what you just said is just spot on. Because what's happening in the last 6 months, precisely, if I look at the period, I think you can take the period from, let's say, January, or to be more specific, the day after the budget came in. So let's say on 1st of February, till now, markets actually, which were on a roller coaster ride for the last calendar year, 2017, just suddenly took a break. And with a lot of changes happening in the global economy as well as the Indian markets, for example, a taxation happening on the long-term capital gain on equities, we just put a setback on the overall markets perspective, followed by concerns on the trade war happening between US and China, because they are the two big daddies in the world, and your oil not helping Indian markets, because I think India imports 40% of the oil consumption, putting pressure on your inflation. So all these things have their own weights around the overall development in the markets and the economy also. So what led to this was that the mid-caps, which actually had a very, very nice bull run in the markets for 2017, just took a pause. And eventually it was started to going down, which led to few stocks going up, which were more on the large cap side. And they were actually the superior large caps. And to name of them, there were very, very few 5-6 stocks, which actually constitute a larger portion of your index in the BSE 30. So those 5 stocks which went up, let's say like an HDFC Bank or a TCS or an Infosys or Reliance, actually have a 66% weight of the index. So those stocks led to that rally. And while the other 25 stocks within the same index also went up, but not so much, some even went down. So overall, you saw a 10% growth in the index, and typically the media just blasted that the markets are going up. My index from a 36,000 levels went to 38,000 levels, and only in the last fortnight, if we can say that, I think the last 15 days of July and now of August, we can say that markets are seeing a little bit of overall rally, which sees the other stocks also participating, including the mid-caps. But yes, the damage was done. Mid-cap stocks as an index were down around 14 to 15%. The small caps were even worse off. They were down 20% on the index side. And this is only the index, mind you. If I scratch the surface further, you find it was really a bloodbath. But on the contrary, it was not bad, because the stocks which have just led to the rally, you could also sense a lot of frothiness happening in the markets. And those were the stocks that started to bleed much more. So now markets corrected. Still, you see that the index has gone up, but my valuation in my NAVs of my portfolio are not commensurating with the returns. So logically, investor will always raise this: why is not my portfolio performing? But if they further deep dive into it, they will find that the large caps are much better off vis-a-vis the mid caps and the small caps.
You've seen several cycles of the kind that we are seeing today, where a certain section of the market is going through a bit of a bear run, so to speak. This keeps seeming to happen all the time, periodically, because equity is not a linear kind of an asset class. What do you tell your clients at this point of time? Are they panicking? Because we keep talking about maturity coming in investors, where they are willing to stay put even if they are seeing a fall. Is that really true on the ground? And what would you tell investors to do if you have a portfolio of mutual funds right now and you're not necessarily seeing just those 4 or 5 stocks doing well? What should you be doing? Is buy right, sit tight, a good strategy to adopt at this point?
It always is. I think if you have the right allocation in the right asset class and the purpose of the investment is met with the perspective of the period you are doing the investment for. Just to make it more simpler, if you are buying your equity assets and it's meant for long term, there is no reason why I need to prune or change my portfolio if I have bought the right stock or have bought the right fund. It's all about the patience and you have to hold that investment for the right period. And that's why we say the percolation period of equities is actually long term. And that's why we always say that the equities are meant to be a long term play and not a short term play. Short term play is more of a luck. While vis-a-vis a long term play, they will actually pay out you over a long period of time, provided you are able to have that riding that volatility period, which actually is the case. And equity is actually all about volatility. If you are able to ride that, there is no reason why you will not make inflation adjusted return over a long period of time. Now, how do you define that long period? Typically, anything less than 5 years, don't look at a pure equity asset class. Do look at maybe a hybrid combination with some exposure, but pure equity with large cap or even mid caps and small cap have to be 5 to 7 to 8 years of investment period. Otherwise, the chances of losing money could be high. Mind you, it doesn't mean that an 8-year period guarantee you a return, but the probability becomes in your favor.
Talking about mid-caps, Surya, when we saw this good run in the mid-cap story, which kind of halted in the recent past, and mid-caps saw a lot of losses, and so did small caps. And I remember that a lot of questions around that time came from people saying, I want to buy mid-cap. This herd mentality approach, that just because a particular category of the market starts doing well, we jump and say we want to go and buy just that. And then when it falls, we say that, oh my God, what just happened?
That's very true. You always see a herd mentality. We have done it many a times
earlier.
Has that changed? I don't think so, Vivek. And I think it's very hard to change. What it requires to really change it is in your mind, which requires a lot of knowledge transformation, requires a lot of imparting knowledge to the investor, not chasing the returns just because the last 6 months, the last 1 year have seen an excellent performance. Past track record is a good indicator of the past, not of the future. Of the future, I have to see what the valuations are. We can understand that for an investor, that's very difficult to follow. But what an investor can do is to understand the risk involved in that particular asset class. If I'm buying a mid-cap, mid-caps carries an inherent risk within the equity frame of the highest order. Small caps are even higher. And if I buy a sectoral call, which was also happening in a big way, that's on the highest pecking order of the risk category which you take. So to diversify within the equity basket, you have to make sure that I have an exposure which is reasonable between the large cap, the mid caps and small caps. At some point, some will do, at some point, some other class will do better. For example, last year, large caps did not participate. They did well, but the herd mentality was much in favor of mid caps. And look at this year, large caps are the superior performers. It doesn't mean all my portfolio needs to be shoved into the large caps now. Because overall, if I am true to my label of holding for 7, 8 years, if that's my allocation, there is no harm even now to have your exposure in the mid-cap segment, provided you are able to hold true to yourself.
So while there are no hard and fast rules that how much should you be in a mid-cap versus large cap, it will depend from your own age or your own risk appetite, etc.
Yeah.
But as a ballpark number, what should be the ratio split?
See, you actually answered it yourself. Logically, it depends on what your age profile is, what your risk appetite as well as capacity is, what are my financial goals which I need to follow. If I have a 5-7 years, I'll prefer to be more large cap oriented rather than a mid cap. If I'm a young investor starting my career, I'm 30-35 years or even younger, I may prefer to go a mid cap biased portfolio. Okay. But on a generic basis, if you check, you should look at around 40-50% of a large cap oriented portfolio. The balance 50%, you can even do a multi-cap strategy. I'm talking about funds over here. So dedicate 40-50% to a large cap, 30-40% to a multi-cap strategy, and 20-30% to a mid-cap space.
When you see big shifts in the market like the way we are seeing right now, you talk about the importance of asset allocation, Surya. So while one thing is about X asset versus another, but do you also recommend reviewing the ratio within, say, a multi-cap, mid-cap, large cap when you have such wild movements? Or do you suggest that within your equity basket, if you've built a certain portfolio, which is partly mid-cap, partly multi-cap and large cap, then stick to it, stay there, don't get panicky at all?
See, when you create your portfolio, you actually look at what you just said. I will look at individual funds which you end up buying to see how much allocation they have as per the objective, the characteristic which they carry of having what kind of equity in what exposure. As per the recent SEBI classification, the game has changed and have become more specific. So now you can actually put a number or close to the number, how much would be my large cap allocation, mid cap or small cap. And within that, it's a value buy, it's a focused equity. So you can create your own template in sort of a manner. But once you have done that, the fund manager do have a leeway to move between the two bands. So therefore, if you say, if I was a 50% large cap, but after 1 year, if I am reevaluating the same, I have become 70% large cap, I think you have to give the dues to the fund manager to hold its forte. He's the guy who's calling the shots and he's buying the large cap because he's believing that large cap will have a better performance. So if there's a change in the portfolio happening because of the fund manager, let it be for some time. Unless you really want to go your path and want to have very strong exposure and you strongly believe in yourself. But what we believe that if you're giving a call to the fund manager, stick to it for some time. There may be a reason, rational reason, which may or may not pay. It doesn't mean that he will always be right, but at least the intent is there to protect your capital in the larger picture. However, if you believe I want to follow my path, you can always tweak your portfolio.
In volatile markets such as the kind we are in right now, does an SIP therefore become even more imperative rather than a lump sum?
I think SIP makes sense in all markets. And why I say this is with more thrust on it simply because markets will be volatile at all times. Every time there will be a different reason which leads to the market volatility. Next 6 months, it could be the Indian politics. You never know. After 6 months, we just don't know what's going to happen. So therefore, SIPs are the best way if you have regular income, start creating your long-term portfolio with systematic investment plans.
Thank you very much, Surya, like always, for joining us
Thank
here.
you, Vivek.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.